Good afternoon, everybody. Thank you for joining us here today. I'm excited to have this group of panelists here with me to discuss standardization of tax credit agreements. So the American Clean Power Association launched a working group to come up with some standards for tax transfer agreements. And some of the folks involved are here in this panel today. And we're going to just walk you guys through what we've accomplished and what's next. So before we start, I just want to quickly introduce my friends here. Basan Shane is a senior counsel at Norton Rose Fulbright. Tarek Hanna is a director at Bank of America. Susan Hickey is the chief client officer at HASI. And last but not least, Jake Wolf is a general counsel for Crooks. So welcome, everybody. All right, let's get it started. Susan, I'm going to start with you. At the time ECP launched this working group, you were the chairwoman, and it was pretty much your vision to put this group together to work towards the standardization of tax credit agreements. So what was your motivation? What was, what drove the idea behind all of that?
We've known for a long time that our market is very dependent on having tax equity as part of the financing structure. And back after the Inflation Reduction Act got passed, and we have Ethan Zindler here who with us from Bloomberg, who's also part of U.S. Treasury, the industry worked hard to say, oh, gee, what can we do to expand the tax equity market? And the answer is, well, we came up with something which is transferability of tax credits that still had bells and whistles around them to protect the nature of the investment and intent of the tax credit being transferred for good, solid projects. So with that, we achieved some simplicity, still some complexity, but it let us really evolve away from the traditional tax equity partnership. And so as we had that victory, it's like, great, let's go do tax equity transfers. Some of my colleagues here on the panel who've been longtime investors in tax equity partnerships, brought in corporates and other taxpayers, insurers, and said, great, you can now invest in clean energy. We'll figure out how you can come in as a tax equity buyer. But what seemed to happen is certainly there was initial interest, but what we heard about 9 months into it, which was 2 years ago, actually at this conference, as we got different stakeholders around the table, what happened was, oh, well, we're bringing in new buyers, but we're sort of still stuck in, they call up lawyers, they talk to their internal groups, and are starting to still treat this as a project finance deal. Lots of due diligence, not understanding, not getting to what we hoped was more of a simplistic way to transfer tax credits. So that led to us all saying, gee, and now we've got the demand growing, and we also have tax credits which will become available for other technologies, so we need even a broader universe than ever before. So the solution was, why don't we get stakeholders together and brainstorm how to come up with some documentation that could really drive the market. And the analogy we came up with was, look at how successful the interest rate, how the interest rate swap market has worked. The industry got together, came up with a standard document known as the ISDA, and with that, certainly every transaction may be different, so you'll have schedules that let it be adapted. But that has really, when you look at how those interest rate swap and other derivative markets have become standardized, very deep, very liquid, was our goal. So the next piece of that was, in order to, while we have different banks that are tax equity investors, we have buyers and sellers, we have tax equity lawyers that represent both sides, why don't we get a well-rounded group and get a few people who volunteered to dive in, and under the American Clean Power Association umbrella, work on this together and work on it in an open environment that's meant to be available for everyone. And ACP, one of our obviously core missions and principles is governed. I think Brett White should be in here from American Clean Power. There you are, thank you. I wanted Brett to be here. He's one of our counsel, is to abide by and honor and ensure that what we're doing doesn't violate any antitrust rules. And so ACP has spearheaded this. And so we're excited to talk about, with my panelists here, where we are today with the first step in this standardization and how it played out. And with that market testing, where do we go from here?
Thank you, Susan. Appreciate it. And it was a very interesting group of folks that worked together with very different perspectives on the market. So it was a fun exercise. Jake, Crux has been involved with a number of TCTAs, connecting a very diverse group of sponsors with a very dynamic group of buyers. I remember when we launched this project, you guys were already starting some standardization on your own, off-the-shelf stuff for your clients. So tell me from your perspective, what motivated that, and who do you think is benefits the most with that kind of a standardization?
Yeah, absolutely. Thanks, Daniela, and thanks for everyone for attending the talk. It's a lot of what Susan was saying was really resonating. It's such a unique opportunity to get to be involved in a market that is really brand new, right, and is sort of being built up from scratch. I've never done something like that in my career, and I know most people kind of are embedded in these markets that have had a lot of time to be built up and to standardize and have different standards and whatnot. So I think when the IRA passed and in sort of the early days of the market as Crux was getting started, we were seeing all these really interesting dynamics, right? You had a number of new participants on both the buy side and the sell side. On the sell side, you had folks like 45X manufacturers who, prior to that time, had no interest in clean energy tax credits because they weren't eligible for them, right? You had smaller solar and wind developers who maybe had been producing credits in the past, but were not able to take advantage of the traditional tax equity market, so they had not done a lot of those deals. And then on the buy side, it's true that you did have some of the traditional tax equity investors who became buyers of tax credits, but you also had a lot of new U.S. corporates who had not traditionally been part of that market who all of a sudden were there. So I think that those dynamics, both the new participants as well as the new asset class, sort of created this dynamic whereby we kind of all realized we're going to need to provide some guidance and some structure and some standardization. If these types of transactions end up looking like tax equity or debt finance from sort of a complexity and documentation standpoint, the market's not really going to reach sort of its full potential. And so it's something we've been thinking about for quite some time. We put together standard TCTAs sort of early on as a company, and we've started to explore sort of standardization in lots of other parts of the transaction structure as well. So things like term sheets and diligence checklists. Standardizing the diligence process is something that's getting a lot of attention. What is the appropriate scope of things that buyers should be asking sellers for? We've heard a lot of chatter about insurance, and so there's all these really interesting new opportunities that kind of come from the TCTA, which was obviously the most sort of fundamental piece of the deal. But we see sort of the same type of themes continue to resonate throughout other parts of the other parts of the transaction. In terms of who benefits the most, I think it's probably easy to say that smaller transacting parties probably benefit the most, and our data does show that in the small deals, sub $10 million credits, they use our transaction forms almost half the time, and that's probably relatively obvious. They're more sensitive to cost. They want streamlined transactions, et cetera. But I think the answer is probably a bit broader than that. We spent a lot of time thinking about buyers, right, and what is necessary for buyers to come to this market and transact. One of my favorite statistics from our recent market intelligence report, which we'll talk about in a bit, is that 27% of the Fortune 1000 of U.S. corporates participated in the transfer market in 2025, and that's up from 15% in 2024. So really a material increase, but at the same time, you still have 73% of that market that's not participating, right? So it's tremendous progress, but it's also a big opportunity. And what we consistently hear from buyers is that they want simplicity, right? They want streamlined transactions. They want risks that are well understood and covered off on through documentation and other tools. What they don't want to hear is, wow, this is a brand new market. These transactions are really complicated. There's lots of risks to work through. The negotiations are dogfights. Like, that is not what a tax credit buyer wants to hear. Again, going back to the point that these are not traditional participants in these transactions, and we are trying to bring them to a new marketplace. It's a very delicate process, and efforts like the ones of this group are really crucial to trying to bridge that gap.
Thank you, Jake. Tarek, do you agree? I mean, BofA has been super active in this market. I would say even more so after transfer with hybrid structures and et cetera. So do you agree with Jake in terms of where we are and the advantages of that?
No, absolutely. I think one of the items I would highlight is that the more companies that have done tax equity before, they're used to these highly structured transactions. And so, yes, like these companies have driven some terms, but that doesn't mean that, the broader market, wouldn't benefit from more standardized terms. Sure. And that's what, this working group has focused on. I think one of our objective functions was to keep it balanced, not make it buyer-friendly or make it sponsor-friendly, and for obvious reasons. And do we think everybody's going to use these terms as is? No. Like, ISDAs have schedules that are, change ISDAs, and so we anticipate that to happen here as well. I think it comes down to the most subjective part of these negotiations usually are around tax contests and what is your tax analysis and what is your tax department used to doing. Right. Some are more conservative than others, and that's you can't. There's no workaround. And the bigger the company, the more they're set in their ways in terms of abiding by a standard doc. But that said, it still gives a framework. It still gives a starting point, and we think being in the middle is important as a starting point, and then folks can negotiate. And then I agree with Jake that it's every time I go into a transaction, I'm like, this should be simple.
Yeah.
We've done a repeat trade with the same sponsor and the same buyer, and we've had a negotiation, and I blame it on the lawyers. Sorry, not this one. But, apologies to the lawyers in the room, but look, I get it. Every lawyer has the they need to get the best deal for their client, and I understand that. But yeah, this standard doc, I agree with that, everything. Jake.
The reality is it's still very early days. I mean, this is a market that started really last year. So the more liquidity exists in the market, it should trend into a more standardized type of negotiations where those things tend to get muted because they are resolved.
And everybody's using the same 10, 15 law firms. Exactly. So like everybody's seen terms. So back in August 23, we did the first transfer deal in the market. Yeah. As a buyer.
Yeah.
And they were able to raise financing on the back of it, which is a big win. And so that first DCPA, we've seen some of those terms come full circle to us as a seller,
right?
Which we couldn't agree to. But as a first trade, you're taking risks, so we needed to be very buyer friendly. But yes, I agree with you.
Great, fantastic. Well, this is great to go back to Basan here.
To defend myself now.
Yeah. So NRF was one of the 3 law firms that was involved with this working group, and you guys obviously have like a wealth of experience representing sponsors, buyers, sellers, cap stack, and et cetera.
Yeah.
So you obviously brought a lot of experience to the group here. But how realistic do you really think the adoption of this standard document is? And to Tarek's point, I mean, is this good business for law firms?
Look, I do think that it's good business for law firms. Let me start there, because this is a process that should make TCTAs more accessible to a broader segment of the market, right? Actually, Jake touched on it. in his answer, the dynamic that I find, frankly, fascinating is that we have very sophisticated commercial parties that don't know what tax credits are, haven't been involved in tax credits, haven't done tax equity financings or project development or anything like that, that suddenly are in there. And to the extent that you can start from something that makes them feel a little bit more comfortable and that it is a little bit more accessible, I think that's a good thing, and ultimately we'll all have more work out of it. In terms of how realistic it is to have a single standard form, probably not. It depends on the segments of the markets, right? I think I would look at it as there is a portion of the market, the newer entrants, smaller transactions, buyers that don't have tax teams that are very particular about how they like to do tax contests, for example. That segment of the market is perfect for a standard form, and it can make those transactions very, very cheap and efficient. I think there will always be participants in the market that either because their tax teams require something, or you know what, they are also tax equity investors, so they're just used to seeing certain deliverables, or it's a transaction that is part of a broader tax equity or project financing type of transaction that those all have their own bells and whistles. And the standard form is probably not going to be able to satisfy those needs, although it may inform those kinds of conversations because it is setting a part of the market.
Right. I think that makes sense. Again, as there's more liquidity in the market, maybe things start to trend, but not today quite yet. Jake, I'll get back to you. You guys published the State of the Clean Energy Finance to 2025 Market Intelligence Report with some very interesting data on how this market evolved. One of the things that I found very interesting on your report is that transferability has not only created an alternative to tax equity, but it has actually multiplied tax equity. So which gives the market what the market needs, which is more options, right?
Yeah.
And more volume there.
Yeah.
So can you give us some general highlights on that report?
Sure. Well, we can talk about the hybrid deals because I just think it's so interesting, and I'm sure everybody on the panel has thoughts on that. But I can touch on a few sort of quick highlights. So the first is that, sorry, go to my notes here. There we go. So this market continued to grow in 2025. So the total amount of credits that were monetized were up to $63 billion, which is a 27% increase year over year. But getting to the second theme, it really was sort of a market of two halves. And so, for the first time in this transfer market, we saw the total volume in the second half of the year decline to the first half. Typically, you would see more volume in the back half of the year. But volume was down as a result of large corporate buyers pulling back on their purchases. That sort of decrease in buyer demand also led to a decrease in pricing. So we saw about 1 to 2 pennies of differential pricing in the second half of the year as opposed to the first half of the year. To Daniela's point, hybrid tax equity structures really boomed. So we tracked $27 billion of hybrid structures, up from 18.9 in 2024. Let's talk a little bit more about those in a second. As many of you can predict, tech-neutral credits entered a choppy market. And those are, of course, credits that are subject to FIAC requirements. Not seeing a lot of tax equity activity around FIAC transactions quite yet. We surveyed investors. Most said that they were not looking at them. Of course, this was during the back half of the year. We're seeing a little bit of uptick in activity here in 2026, but obviously still people are treading lightly as a result of uncertainty around the rules for tech neutral. And then to the point I made earlier, buyer participation really broadened. So 20% of the Fortune 1000 was in this market, and as you can imagine, we see buyers from every major sector across U.S. corporates. I just wanted to go back to the hybrid point. It's so funny because when I first started at Crocs, there was this real sort of dichotomy, right? It's like you were going to do a transfer or you're going to do tax equity, and they were almost like in this fight against each other, right, in terms of how you heard the market kind of talk about the different transaction structures. But I think very soon thereafter, you started to really see this convergence in that, the ability to transfer credits out of a hybrid structure was actually a really effective way to recycle capital. And to the extent you had tax capacity as an investor, you could sign up a hybrid deal, you could internalize the credits, or you could transfer them out and then go do another deal. Tying it back to sort of the standardization theme, Crux is now in the hybrid market as a direct investor, and the transfers are so fundamental to making the hybrid deals work that the less uncertainty related to the transfer, including documentation, negotiation, that is such a win for the underlying tax equity deal. The underlying tax equity deal is going to have all the complexity in the world, right? The documentation is going to reach into the hundreds of pages. Lawyers are going to spend a lot of time and money. I think everybody sort of accepts that cost when they're doing a hybrid deal. But that transfer is sort of waiting there in the background, right? And sometimes the transfer will be negotiated concurrently. Sometimes it will get done after the fact. But it really needs to get done unless the investor, wants to internalize the credits. And so, just as sort of going through this as a principal participant, the less uncertainty on the transfer side, the better. And so I actually think it's really one of those opportunities where, even if you are a large, sophisticated player, getting some more certainty through standardization and otherwise on the transfer component of a deal in order to give you more comfort on the underlying tax equity is really important.
That probably also impacts bridge loans in very much the same way, right? If you're bridging to a transfer that has not yet been signed, having a standard documentation or at least a more predictable process makes that a lot better from a bank's perspective, presumably.
Absolutely.
For sure. Jake, I think in your report you guys are also projecting 2026. Are we projecting growth?
Yeah, we are projecting growth. We'll have some new Q1 reports out in the next few weeks. I won't steal our marketing team's thunder. But at the end of 2025, effectively, as I mentioned, we saw all these large buyers sort of sitting on the sideline in Q3 and Q4. And so what we have projected that to the impact of that to be is that you have a lot of 2025 credits that haven't been sold yet. So those credits will need to be sold sort of, between now and the tax filing deadlines in October, assuming a calendar year filer. And then, we would also predict some bounce back on pricing. So going back to your original question, we do think the market will grow off that $63 billion number. I think the projection is somewhere like 65 to 70. And we do think there will be a bounce back in pricing. I should also just mention, I touched briefly on FIAC. We did some surveying and sort of market data gathering relating to safe harbor projects, and there's something like 160 gigawatts of tech neutral credits that have been safe harbored, and then something like half of those should be FIAC exempt. So there are a lot of credits still in the market that will be transacting over the next 1, 2, 3 years that are somewhat removed from some of the other risks that, of course, we can talk about and we expect to sort of reach a good point on those. But, nonetheless, there are a lot of credits that are sort of separate from that we're seeing transact right now, and which we think will lead to that increased volume this year.
Great. I'll come back to the FIAC point in a minute. But Tarek, are you seeing the same thing in terms of opportunities and growth and activity?
Yeah, absolutely. So many points touched on there, but in terms of safe harboring, yes, the majority of the sponsors we deal with are larger, established, and they've done a good job in making sure they have runway until things kind of materialize on the FIAC side. So we've been, active, both debt, tax equity in terms of renewable energy. Yes, the vast majority, if not all the transactions we do from a tax equity perspective are hybrid tax equity perspective.
Right. I was going to mention, I think BFA, this was really an interesting market for you guys because you guys became quite a bit more active on the tax equity with the hybrid structure, right?
Yeah, absolutely. And we, some of the first transactions we've done on the transfer side as a seller, we actually retrofitted some tax equity that we already have from our legacy book to do them, to incorporate transferability in there so that The message behind that, and I see people in the room here that were part of that effort, the message behind it was like, hey, this is a deal we underwrote, and we were taking the credits, like vote of confidence, skin in the game, and we want to like do a transfer out of those, not out of a new project.
Right.
So, and it helped solidify some of the trust in the market with these few, first deals in the market. And so, yes, so in terms of hybrid, absolutely, it's always, part of the structure is having transferability option. We may decide to sell, not to sell. It's our, discretion. It gives us the flexibility. If buyers want, to look at a deal, it shows that, hey, BofA underwrote these credits. That's a huge stamp of approval and quality, which buyers really enjoy. And we also have the corporate connectivity, obviously, from a corporate banking perspective, which is a large franchise that we leverage for the biggest taxpayers. So all that said, like it fits, beautifully with the hybrid.
Awesome, fantastic. So before we move on to next steps on this group, I want to just touch a little bit on FIAC. I think, Jake, you mentioned a lot of 2025 credits that are still being taken care of. FIAC exempt post-2025 credits that are trading. What is going on with the 2026 tech neutral market? Are we trading? Are we not trading? Understand insurance is not covering FIAC risk yet. How are we seeing this market progress?
Yeah, I'll give my perspective, and then would certainly love to hear from the other panelists. We're seeing the most, obviously not many 2026 projects have been placed in service, right? So the credits for the most part are not ready to be transferred. Where we're seeing this come up is on tax equity deals that are being negotiated right now for projects that will be placed in service later in the year, or maybe even next year. And obviously trying to get out in front of like what do the FIAC requirements look like. So it's a little bit kicking the can down the road, right? Because you don't, for example, have to have the insurance policy in place today. It will be a CP to MC funding. We have not seen policies meaningfully cover that risk yet. We started to see those conversations happen. I think the insurers are trying to begin those discussions, but not necessarily, signal any, super committed willingness to cover off on the risk. You're also seeing a lot of activity around representations from investors as well as banks, and what they will give in terms of FIAC representations to get developers comfortable. Banks, for the most part, will give a knowledge qualified SFE rep. That's all they will give. I think the market has sort of coalesced around that. As to what tax equity investors will give, I think that's a much more open question. We've seen a lot of negotiation on that. Some tax equity investors are comfortable, saying that they will not cause the partnership to be an SFE or an FIE. Others want knowledge. Others have uncertainty around their lenders and the 15% rule. Those are some places that we're seeing a lot of tension. We've seen some deals get done. We've also heard about some deals go on pause over them. I'd say, for the most part, I think the market has, digested the information that came out of Treasury as helpful. Obviously, that publication only addressed material assistance, right? So there's still a lot of questions at the effective control level, as well as just the entity level. And so, lots of activity. We're hopeful that like the market is engaged. They're thinking through issues. They're coming up with creative solutions. But I think we're still relatively early.
Let's take one step back, because we're using acronyms. Probably everyone's familiar, but when we're talking about FVOC and PFE, that's a tax, and in the bill that was passed with OB3, tax credit buyers were deemed not to be able to use clean energy tax credits if they were deemed to be a foreign entity of concern or a prohibited foreign entity, which ties back to China and other named countries, Russia, North Korea. So that's the genesis of this. There's been a lot of precedent in this. We don't think as an industry that was meant to capture our big banks, our corporations, but because of the binary risk, the industry was waiting for, and it just became effective in 2026, January 1st. I'm trying to put this in simple layman's terms. We're waiting for Treasury just to provide the clarifying guidance about how that ownership test and determination was going to be met. That had been, and certainly, you know, American Clean Power, ACOR, the banks, they've all coalesced and provided, been actively involved in the comments. So there's, we talked about how this is technical, that whenever Treasury, which could happen anytime, comes out with that specific guidance, they'll follow the partnership and the intent, and then we'll have that ambiguity cleared up. So that's sort of, I try to boil that down to very simple.
Background and clarification.
Yes. So in the meantime, as we know, in the meantime, that's caused a pause, and it hasn't impacted as much this market because we're still have a lot of, as you say, projects and safe harboring that this FIAC particular rule doesn't apply to yet. So just want to back up.
How are you guys assisting folks to kind of close that gap?
Yeah, so I think
Like, should level opinions are probably not at the table
No.
yet, but
no, I think part of the answer is it kind of depends on the type of transaction, right? And if you have a particularly creditworthy sponsor, for example, the buyer might be comfortable with a rep that is just covered off by the guarantee and doing their own diligence, and maybe law firms are involved in doing the diligence and providing memos to the client and things like that. But ultimately, the buyer's getting very comfortable because they've got some kind of creditworthy guarantee backstopping that risk. Where that's not in place, which frankly is a very large segment of the market, and insurance is expected to provide the gap in credit, that's where I do still think we have an issue for now, right? We are seeing tax credit transfers being done with respect to 2026 TCTAs that would be subject to the FIAC rules, but those have conditions, right? To Jake's point on MC fundings for tax equity would have some sort of condition on the binding. It's not just tax equity, it's also the purchase of the tax credits. You might be able to put an insurance policy in place that covers FIAC, subject to acceptable guidance being published by the IRS, right? Which at this point is meaningless. So when Treasury passes that, then perhaps, depending on what comes out, that insurance will snap into place. So we are seeing deals being done in that basis, and you can consider that perhaps that risk is still with sponsors. I don't know that law firms will really be able to bridge that gap. It might help with providing memos if, at that point, that assists insurance in being able to provide the policies.
thank you. So let's get back into where we started with the standardization work. So Susan, what's next? What's ACP going to continue to drive this in terms of, so we have a TCTA, by the way, I think this is where folks can find this form of TCTA that is the product of this working group. This is what you're going to see there. It's a form that covers ITCs. I think this group would going next on a similar format for PTCs. Obviously, this form doesn't cover FIAC yet, so those are updates that will continue to happen as the industry evolves. But what's next, Susan?
And I want to thank the working group who spent the hours on the phone, and a couple of the members aren't here on the panel today for representing the industry. And I would like to say American Clean Power is the leading association for the clean energy industry, particularly utility scale, wind, solar, storage. But I do want to say, HASI, we're a financial investor in the marketplace in clean energy. We're not a tax equity investor. We're neutral. But I want to, before I get totally into what next, what we see when I talk to my relationship as chief client officer with our clients, who could be one of the big companies on our board, American Clean Power, but we're also at HASI a leading player in investing in distributed generation, RESI, and also I've got one of our members on our fuels, transport, and nature team. The amount of credits, almost every transaction that we're going to be involved in as a cash equity investor is going to have some component of tax credits. There's still some clarifications done, but there's emerging tax credits for fuels. And we saw today the trends and how much storage is going to take off. So I want to say that we are hosting it under the ACP. It's a natural umbrella, but there isn't a CFO that I talk to across all of the spectrum. Our clients are like, "Oh my gosh, that's a great idea. I didn't know you were doing that, there couldn't be anything more important to expand the market, whether it's doing a hybrid deal with the banks or whether it's doing a standalone deal or whether, oh my gosh, some of these transactions are getting to so big because of the size of the project, or it's an offshore, and we haven't even gotten to nuclear. It's going to be $1 billion tax credit kind of transaction just for one project. So I just want to say that this is for, ACP is committed, and I'll talk about the next steps to do this, but we feel this is a universally being supported. So how do we bring this standardization out? First is what's next steps, and I think Craig's too for helping figure out, is there a market for this? Are we going to get some uptake from all the work that was done to do the first IT standardization document? So the answer is yes, we've seen that. So next, besides the PTC, what we've heard in talking to different stakeholders is, now let's make it simple and say, hey, what's the standard due diligence checklist and what's the due diligence roadmap, both for education and comfort to buyers, so you don't end up with, one of the other tax equity banks said, I bet you could eliminate about $500,000 often because a buyer they don't know and sort of go down, oh, well, then let's just check all the bells and whistles like it's a project finance deal, for example. And insurance is the other one. Certainly there's a huge reliance on the insurance market, but what's standard, what are the provisions, and what's not an over ask or reach that really isn't insurable. So that component is next, and appreciate the volunteers, and it'll be, again, Brett's here, ACP will provide the umbrella and neutrality on that front. But importantly is how do we get the word out? How do we get the adoption out? So we have an initiative now planned to work through different lists of CFO and the finance teams at our companies, at our partnerships, do some webinars, hold some office hours, point them in the direction, and put out an educational, more educational pieces on what we have and what's been successful. Obviously, while we have tax equity lawyers, there's really just a smaller group who, because it's so specialized and technical over the years, several have been involved in this working group, but we'll expand that, same with the insurers. And then, of course, we need the corporate buyers in the room. So I know certainly B of A and Crux have held forums where they're bringing current corporate buyers who are involved in the market, those interested, to come in and have an education not only on the industry and how this all works, but we'll use those forums to say, here's a standardization approach that could help you and your respective councils. So I know we'll plan some of those here in New York. The Clean Power Convention that ACP has will be in Houston in June, which would be, we hope, a great place for the market to also come and visit buyers and see what's going on at the convention. But that's our next plans to continue to move this forward, and we're really excited because of the super importance of this being successful for the marketplace.
Thank you, Susan.
Thanks,
So a lot of work to come still, but I think the most difficult is the first step, and the first step has been done. Yep. And so hopefully now it's kind of like optimizing around the edges and making sure that the forms are updated for the latest in the market and et cetera. And to your point, adoption. Like, it doesn't make sense to do all this work if we can put the word out there and there isn't like a willingness to adopt that, then it's all dead in the water. So I think this is great, and I thank ACP for kind of like pushing this agenda forward, and obviously all of you guys that have been so helpful during this process. So with that, I will open to questions, if anybody have any questions that the panel can address.
Quiet.
Thank you.
We've got a question back there. There's a question. Oh, yeah, we're in the spotlight, so we can't see.
Hi. A question for Jake. Where's the volume of the tax credits coming from currently as it relates to storage? Is it mostly C&I? Do you see an uptick in residential or other sectors?
Yeah, I think I don't have the breakdown of storage in particular, but I do think that we put out in our report that we expected it to I forget what the exact multiplier is, but that the growth from storage from 25 to 26 would outpace the broader growth in the market. So, I know that there has been some, rockiness with certain projects and, kind of things on the ground, but just from a, tax credit monetization perspective, there's a lot of storage credits to be moved, and, we expect that will drive a lot of the growth, going out into future years.
Is that report out yet?
Yes, yeah, that's our 2025 MIR. Yeah.
Maybe I missed this, but you talked a little bit about the need for corporate demand on the buy side. I guess how is sort of buy sell side matching up? Like, is all of the supply transacting? Is there supply being left on the table today? What does that look like?
Yeah. So this is such an interesting topic because when the transfer market really started out, it was a seller-friendly market, right? There were not enough credits and lots of new folks who were new to the market on the buy side who wanted to transact. And we really saw those dynamics, I'd say, in 23, 24, and maybe the first part of 25. Things really flipped in the back half of last year. And that was due to some of the uncertainty in the market, around OBBB, et cetera, as well as uncertainty with corporate tax buyers knowing their ultimate capacity due to some of the unrelated changes also in OBBB related to how you calculate your income. So that has been the dynamic we've been working with, I'd say, for the last few quarters. I think it's starting to ease. We started talking to buyers as part of our surveying process sort of at the end of 2025, and what a lot of them said was, we've been on the sidelines because we've been trying to figure out our capacity, but we think we sort of know what our capacity is now. And then another kind of additional group said, we'll know by the end of Q1. And so, that's why I made the point during the presentation that, you do have credits for 2025 that weren't monetized by the end of the year. Of course, they can still be monetized in 2026 going out until the tax filing deadline. So I would expect those dynamics to shift back a little bit. I think buyers will still have, a lot of leverage. But, we do expect, those unmoved credits to transact in 2026. And we also do predict that pricing will ease just a little bit, which points to buyers having a little bit less leverage in the market. But, ultimately, like, especially when we talk about hybrids, buyers are still just so fundamental, right? And bringing to the table, those large U.S. corporates who can transact, quickly, move large credits, et cetera, are really important. We have seen some like mega projects on the sponsor side where the credits are a little bit harder to move because there's only so many buyers who can take a credit off a 800 megawatt project. You can split them up, but that raises sort of its own complexities. But yeah, I think we'll see a little bit of a swing back, but I think buyers will still have a lot of leverage and still be obviously really crucial to this market. The one other thing I meant to say during the presentation, and it kind of goes to the standardization point. Interestingly, in the back half of the year, I talked about how the market sort of slowed down, but actually more deals transacted in the back half of the year. They just tended to be smaller. So you ended up having overall volume that was less than the first half of the year.
And it's very cyclical too. So, and not only cyclical and it's very sporadic, right? It's not a liquid market like a Bloomberg screen that you look at an interest rate. It's very specific to the company when they file and their needs, when they know about their tax capacity. So we've had so many, just one-off like fact pattern that made a deal happen. But at the same time, the grounds that we're walking on are shifting with the IRA and then the OBBB, and so like that cyclicality is also impacted by that. So people digesting that, people and risk analysis and risk assessment at buyers have shifted a little bit. I would think initially the first deals were like, this is an asymmetric view of risk because a tax director has been in in his senior position for 30 years, they're not going to risk it for a tax credit. Like, it's an asymmetric view of risk. Like, what if this whole thing goes away and I lose my job? Which is hopefully the standardization, like, helps eliminate a little bit that it's, that perception of risk. Companies have done repeat business. At least from our vantage point, we're in a relationship business rather than just a marketplace. So to Jake's point, like the big deals that we work on are mostly relationship-based, repeat buyers, repeat sponsors, clearly. And so that cyclicality goes away a little bit. But they still, buyers want to get the best deal they can, even if it's a relationship-based business. But yeah, quality matters. And cyclicality is a big consideration.
Thought there was,
You touched on the opportunity related to distributed generation. Maybe you could just share with us how you think about that. Is there any way to combine projects, aggregate them, because individually they're small, but in aggregate they can be big? Just curious how you think about that.
Yeah, I can take a first stab and then
I'm happy to add as well.
Yeah, I mean, look, from a tax equity perspective, we've built a leading DG tax equity business and lending as well. The thing that was most challenging is, hey, Resi, everything is so standard. There's 1,000 credits grouped together, but it's so standard that you can, if you underwrite one contract, you underwrite all contracts. Utility scale, one project, you diligence one project. DG is in the middle, and the diligence is where I think it was the most interesting to figure out, okay, what is the framework that we want to set up for diligencing a DG portfolio? And we spent so much time on this because we've transacted a lot in the DG space from a transfer perspective as well. So a lot of thought has been given to, okay, set up a framework, follow it, and that way it's a systematic way of diligencing, but it's not cumbersome either. But I would love to hear from you.
I think DG, the only way you can do it is by putting a bunch of projects together in a portfolio. Like, nobody is going to finance one-offs. It's extremely expensive, time-consuming for not a lot of dollars to put to work. So folks put portfolios of things together. Then the question is how folks like Tarek and lenders go about diligencing this thing. They can't apply the same diligence level that you apply to a utility scale project because it's cost prohibitive, and the human time needed for that also doesn't make sense. So I think the industry has gone a long way to create ways to systematically describe how due diligence works on a DG portfolio. It's still not as obvious as Resi, to your point, or utility scale, but I think a long progress has been done in terms of financing those projects. I would say on the spectrum, C&I continues to be in the middle in terms of attractiveness for tax credit buyers, tax equity, and et cetera, compared to utility scale and residential solar.
I mean, it's diversified,
Right.
which is great for a buyer.
Right.
So yeah, we always pitch it like, hey, it's a little bit more complex, a little bit more hard work, but it's diversified, and you get a cent or two more
Right.
of discount.
That's right.
No, that's
This one.
Again, thank you, everybody. The one question I had is, if you take a look at other sectors like waste to energy or alternative fuels, are investment tax credits available in those sectors as well? From a developer's perspective, some of those projects may be at FID but not COD yet, so they can't monetize the credit until another couple of years. At one point, there was talk of third-party tax transfer investors coming into the space and maybe monetizing those tax credits early and then on-selling them. I'm curious to see if that's still occurring, if that market's developing, almost like a forward market for tax credits. Thank you.
I'm not familiar with it. I don't know if it
Isn't it one of part of the restriction and part of the challenge is the credits aren't like tradable on the marketplace because of the concern about making sure that you still have good projects getting built and all that. So I think part of that complexity is who owns the project so that they can transfer the credit once. And so I'm not sure.
Yeah, I mean, on 6418, there are all sorts of timing rules that sort of, I mean, you can buy a tax credit on a forward basis, but you have to be within the right tax year, and it gets very technical. So typically buyers only like to, send cash out the door once the project has been placed in service. But, it doesn't mean that a different regulatory framework might be, suitable for some of the assets that you were discussing. I don't know if you...
Well, yeah, and actually, frankly, I haven't done a kind of financing transaction in that space, but if you think about the equivalent of some of the renewables work that we do, would be financing parties, maybe even tax equity parties that are able to put in cash or debt investments into the projects. And the credit itself isn't sold until it actually accrues or close to, but they're providing a bridge to that moment in time where a buyer would be more comfortable coming in. And of course, there's a discount, right? In the renewables market, that discount for debt lenders providing financing on a project that doesn't yet have a tax credit buyer is fairly well set within the market. Tax equity, I'm sure, also has a pretty good sense of what kind of return they need to have in order to take that exposure, and so it may take some more time to develop in other industries, but you may see that kind of solution pop up as well, because it is being used in other spaces.
Agreed. And it comes at a discount in terms of advance rate from a lender, and also like some protections that have to be taking into account. So like in case there's a failure of procuring a buyer for the credits, then like the BFA desk can step in and sell them themselves. Yeah. Things like that, structural. But one other thing that we worked on, but still in early, is an option on buying credits. So that's pretty cool. I think I've come from a derivatives background, so it's something that we worked on in the last few weeks, and it's an option on buying out of the money credits, but that also gives folks, hey, we have a big able buyer. Yep. They're going to get 1-2 cents of premium, and then they'll be there if you fail to sell the credit.
Helps with the bridge, right?
Yes,
So like the loan bridge, because like the lenders have something to point to that they can advance, and the buyers have the sellers have the opportunity to get a better deal as the time goes.
Exactly.
So they pay for that optionality, but yeah, it's an interesting product. Any more questions? We probably have time for one more. All right. Well, I want to then thank you, the panelists, for being here today, and thank you all of you for making this an interesting section. Thank you.
Thank you.